So, what if the biggest financial crashes of the last 100 years weren't actually random, unpredictable events? What if they all followed the exact same five-stage pattern, a sequence that starts to show up months or even years before the whole thing comes crashing down? Well, there's a historical framework that says that's exactly what happens. And in this explainer, we're going to walk through that very pattern to see how it might just apply to today. Picture this. It's September 1929. An engineer and statistician named Roger Babson gets up in front of a big business conference and says those exact words. You know what happened? The audience literally laughed him off the stage. Newspapers made fun of him, but just 47 days later, the market began a collapse that kicked off the Great Depression.
And this right here really shows you what's at stake. While Babson was sounding the alarm, the most famous economist of the day, a guy named Irving Fisher, was out there telling everyone that stocks had reached a permanently high plateau. Well, when the crash hit, Fisher lost everything. He died broke. Babson, on the other hand, had prepared, and he made a fortune. The stakes really couldn't be any higher.
But here's the most important part. Babson wasn't just guessing. This wasn't a lucky shot in the dark. He had actually identified a systematic five-stage pattern based on things like credit, how concentrated the market was, and what the insiders were doing. And that's the exact framework we're going to use to take a look at where the market might stand today. So, here's our roadmap. We'll start with that infamous 1929 warning, and then we're going to break down each of the five stages, from the credit explosion and the concentration trap, all the way to the insider exit and the final trigger. And then we'll wrap it all up with the big takeaway on how to actually use this framework. All right, let's dive right into stage one, the credit explosion. This is almost always where the cycle begins. It's not about greed. It's not even really about speculation at first. It's about debt. Debt that's growing way, way faster than the actual economy can support. And this just perfectly captures the dynamic. It's this powerful, self-feeding loop, right? People borrow money to buy assets, say stocks or real estate. That buying pushes the prices of those assets higher. And as prices go up, people feel richer. So what do? They borrow even more. From the outside, it looks and feels like a boom, like real prosperity. But what's really happening is that massive risk is being built right into the system's foundation. And history gives us some crystal clear examples. Back in the Roaring '20s, it was margin debt. You had factory workers taking on leverage like they were a hedge fund. Then, leading up to the year 2000, it was corporate debt that was fueling the whole dot-com bubble. And of course, in 2007, it was a massive explosion in mortgage debt and all those crazy complex derivatives. You see? The type of debt changes, but the underlying pattern is always the same. So, the million-dollar question, where are we now? Well, this chart shows the total U.S. debt as a percentage of our economy. And the picture, it's pretty unambiguous. We are currently sitting at a level that is higher than the peaks we saw in both 1929 and 2008. So, according to this framework, stage one isn't just active, it's at a historical extreme. Okay, that leads us straight to stage two, what's called the concentration trap. See, it's not just high prices that cause a crash. The real danger pops up when all the market's risk gets concentrated into just a few key assets. That's what makes the entire system so incredibly fragile. Back in 1929, the superstar stock was RCA, Radio Corporation of America. It dominated the market. In 2000, it was a small handful of tech giants like Cisco and Intel. And in 2008, the risk was kind of hidden, but it was even more concentrated. You had just 5 big banks holding most of a derivatives exposure. So when one of those pillars starts to wobble, the whole building is at risk of coming down. And today, wow, this chart is really stark. The top 7 stocks right now make up over 30% of the entire S&P 500 index. Think about that. So if you own a diversified index fund, you're not as diversified as you think. You're actually making a huge concentrated bet on just a handful of companies. And the rise of passive investing has basically put this whole effect on steroids. Okay, this brings us to stage 3, the insider exit. This is the stage where things get a little more cynical. It's when the people with the best information, corporate insiders, big institutional investors, the so-called smart money, they start to quietly sell off their holdings while the general public is still enthusiastically buying. The playbook is always the same. First, the insiders start selling their shares, but they do it quietly. Publicly, they keep up all the positive talk to make sure nobody panics. This encourages regular folks to keep buying, and in doing so, they provide the exit liquidity. Basically, they become the buyers that let the insiders cash out near the top. We saw it with the Rockefellers in '29 and with hedge funds shorting subprime mortgages back in '07. And today's data, it's sending up a major flare.
The ratio of corporate insiders selling their own company's stock compared to how much they're buying is at an extreme level, one we haven't seen in decades. The people who know their companies best are selling at a historic rate. It's a classic signal that stage 3 is in full swing.
So, this leads us to the final 2 stages. This is the point where the entire system is at its most fragile, yet strangely enough, everything on the surface can look deceptively calm.
Stage 4 is called the liquidity illusion. Here's an easy way to think about it. Liquidity is like the oxygen for financial markets. When there's plenty of it, everything just works smoothly. But when central banks start to tighten monetary policy, like raising interest rates, that oxygen starts getting sucked out of the room. The market can still look healthy for a while, but underneath, its ability to handle any kind of shock is just vanishing.
And what's been draining that liquidity? Well, look no further. The Federal Reserve has recently hiked interest rates at the fastest pace in over 40 years. This isn't just some abstract theory. We already saw the cracks start to show in March 2023 with the failure of 3 major regional banks. That was a direct result of this liquidity squeeze.
And that brings us to the final piece of the puzzle, stage 5, the trigger. Now, this is a really crucial point. The trigger does not cause the crash. The conditions for the crash were already baked in during stages 1 through 4. The trigger is just the unpredictable spark that finally lights the fuse on a system that's already packed with dynamite.
So what could it be? Honestly, nobody knows for sure. It could be a geopolitical event, a big bank failing, a country defaulting on its debt, or it could be something that absolutely nobody sees coming, a true black swan event. The whole point is, when a system is this fragile, almost anything could be the trigger.
So that brings us to the big takeaway. After going through all this, how should we actually think about this 5-stage pattern? Well, it is essential to see it as a tool for assessing risk, not as some kind of crystal ball for predicting the future. And let's be perfectly clear about what this framework is not. It is not a tool for timing the market down to a specific day or week. It is absolutely not a recommendation to sell everything and run for the hills. And it doesn't guarantee a crash of any particular size. This is about being aware of risk, not being an alarmist.
The best way to think about it is like this. The goal isn't to predict the exact minute a hurricane will make landfall. It's to recognize that the atmospheric pressure is dropping fast and the conditions are becoming perfect for a major storm. The difference between Babson and Fisher wasn't about knowing the exact date. It was about respecting the pattern and preparing for the risk.
So we'll leave you with this question to think about. Knowing that this historical 5-stage pattern appears to be active again, how does it change your own perspective on that constant balancing act between managing long-term market risk and chasing those short-term returns? It's definitely a powerful framework for thought.